is Myles Harrison. Myles is the Chief Product Officer at Swiss-based Amina Bank, a global regulated crypto bank, and his focus has been on integrating blockchain technology into customer-centric banking solutions. As many of you know, Europe is a little bit ahead of us on the stablecoins front, and so we asked Myles to walk us through some of the things that they have gone through. Amina Bank's mission is to simplify banking by blending traditional banking with digital assets, with expertise in blockchain strategy, banking, and B2B management. The goal remains to deliver innovative financial solutions that empower customers to maximize their assets. Myles, thanks for coming. It was so nice of you to fly over today, and I'll hand the slideshow over to you. If you need help, I can move it along. But and at the end, I'll come back with any questions. By the way, before Myles starts, people were asking. The conference goes to the end of the day through 5 o'clock. There will be breaks in between. Some of you will be invited into, have already been invited into breakout sessions, but that also provides a 15 to 20-minute break for you if you want to stay through the whole thing. So, okay, Myles, I took too much time. It's your time now. Thank you.
Thanks, Eric. Thanks for having me this morning, and good morning, everybody. So as Eric mentioned, we're going to be sharing today just a little bit about who Amina are, and then coming on to talking more importantly about the MiCA legislation, which has recently been rolled out in Europe, and then some just a little bit of an overview of some of the use cases that we're seeing and how we've adapted as a financial institution. So just to cover, to start with a little bit about Amina. So we are a regulated bridge. We provide a bridge between the traditional financial ecosystem and digital assets and crypto. We support a wide spectrum of different types of clients, everything from traditional investors and corporates through to crypto natives. And they come to us for different needs. So crypto natives primarily for support and help with traditional banking, as well as on the crypto side. And then on TradFi clients come to us as they're looking to diversify into crypto, and they want to access crypto through a safe, regulated, trusted provider. We support individuals, so professional investors, corporates, and then we also work with regulated FIs to help them provide access to these to crypto products through our as a service offering, so enabling them to open up, reducing speed to market, and making sure that their clients can have access to these products and services in a safe and secure way. We were founded in 2018. In 2019, we obtained our banking and securities dealer license with FINMA. So we are a Swiss headquartered bank based in the heart of Crypto Valley. We then obtained a branch license with Abu Dhabi as we continue to see adoption growing in key jurisdictions. We also have a separate Hong Kong licensed entity with the SFC. We recently saw a number of uplifts to that license, including the first foreign entity to be able to carry out crypto spot trading, as well as safeguarding our clients' assets. And more recently, towards the end of last year, and pertinent to today's topic, we obtained with the Austrian FMA a crypto asset service provider, so a CASP license under the MiCA framework. So what is MiCA? Some of you may be familiar already, but just to cover, MiCA stands for the Markets in Crypto Assets Regulation, and it is the EU's comprehensive framework for crypto assets. It does also cover and regulate stablecoins, which is obviously the topic of discussion today. It's really important for service providers, issuers, to make sure that they comply with the legislation, ultimately to make sure that we can protect consumers and that we have a stable and safe market environment, much akin to traditional finance. So things that issuers and banks things that they must think about are maintaining sufficient reserves. So we often hear a lot about reserves and how the reserves are made up. This is incredibly important, and the MiCA legislation sets out to make sure that there is not a scenario, or to avoid a scenario where a large portion of those reserves are illiquid or not able to be accessed in a stress environment, much like we're used to in the traditional finance world. Issuers need to make sure that they're authorized. So it's not just that the bank or a CASP has to have the relevant license across the European Economic Area. The issuer must also make sure that they have the relevant authorization or be partnering with an entity that does have that authorization. And there's ongoing supervision as well. So not just the initial registration, but there's ongoing supervision from the local regulator. MiCA, and particularly with stablecoins, also tries to ensure transparency, and there's clear reporting obligations, something that wasn't required necessarily across all of the countries that make up the European Economic Area. Now there is a consistent reporting framework that these entities must comply by. There are also limits on and restrictions on how stablecoins can be offered. One thing to note is that actually from March this year, stablecoin payments, so any transfer of stablecoins, will actually come under the Payment Service Directive. So Payment Service Directive and PSD2, which you may be familiar with from a compliance and legal framework perspective. Stablecoin payments themselves will be treated much like fiat traditional payments, and therefore entities must comply with those rules and regulations. For the most part, that will mean that a CASP will need to either partner with a payment service provider, or will also need to obtain a payment service provider license from March this year in order to be able to carry out stablecoin payments. So that's transferring stablecoins between two crypto venues, or allowing clients to transfer stablecoins to their self-hosted wallet. Just to touch, I mentioned that we have a license in Austria, but just to touch on Switzerland. Switzerland digital assets in crypto for many years, and was an early mover on the global stage. Switzerland has a slightly different approach, though, when it comes to regulating stablecoins. Switzerland tends to look at it as that it will fall within whatever the underlying and the applicable existing framework. So, for example, if the underlying is fiat, then it will follow the rules akin to fiat, whether that's deposits or payments. And those rules and regulations must be applied to any activity that's carried out on the stablecoin from a client perspective. So Switzerland has taken a slightly different approach. So we are working with two very different frameworks and regulatory regimes. And we also have the SFC, as I mentioned, in Hong Kong as well. What we are seeing is that that MiCA itself is starting to create and starting to progress towards a more harmonized industry, which is going to then enable and fuel further adoption. So that's, a lack of regulatory clarity is something that has historically been holding back the broader adoption of stablecoins. We now have that, and therefore we're starting to see additional use cases gather pace very rapidly. When we think about the different components of MiCA and how it supports stablecoins as well, I mentioned and I touched on the reserves, incredibly important, if you're looking to work with an issuer, one of the first questions that you should be asking is, if it's an existing coin, stable coin, what comprises of their reserves, or if they're looking to launch a stable coin, what is their strategy around the reserves, and overlaying that with the local or regional legislation and making sure that it complies and that you're able to attest to your regulator that they meet that requirement. So that's something that we do whenever we work with any stablecoin issuer in the European Economic Area, or a stablecoin issuer that wants to make their coin available. We make sure that it meets the reserve requirements which are set out, and there are some very strict stipulations within the reserve requirements from a MiCA perspective. Authorization, again, I touched on making sure that the issuer is registered and has the relevant authorizations. Transparency, the reporting. We also have global CARF. So this is the global reporting standards which are coming in very fast down the line. Those will be introduced over the course of the next 12 to 18 months. Different jurisdictions are working to slightly different timeframes, but that adds to the transparency that has been created under MiCA. And then financial stability. So we know that stablecoins themselves, innate in the name, versus what we would call blue chip crypto, or the blue chips, or altcoins, does underlying provide greater stability. But what we need to make sure is that, for example, in a market stress scenario, there isn't what we would call a depegging, and that becomes detached from its underlying. And then that's when there is a potential for financial loss for the end consumer. So we need to make sure that there is that stringent financial stability. And that is something that MiCA covers and sets out for. Just before we head to some questions, just wanted to share how we've seen stablecoin use cases evolving over the last 6 years or so. And really, when we think about sort of the cycle just before the COVID pandemic, stablecoins were being used by crypto natives really for use with trading and as a conduit between TradFi and DeFi. They provide obviously greater stability versus blue chips and altcoins. And at the time as well, a lot of crypto native users, maybe were unable to go straight, directly from those cryptocurrencies into fiat, and therefore they used the stablecoin as that conduit. What we then started to see was evolution, and we started to see stablecoins being used for cross-border payments or remittances. And when we think about blockchain as a piece of technology, we know that payments, and particularly cross-border payments, is a fantastic use case for blockchain, and stablecoins really provide a mechanism to do things faster, to do things cheaper, where it makes sense to. And what we're witnessing at the moment is certainly a different level of adoption in different jurisdictions. So one thing that I'm often asked about is, stablecoin adoption directly within the European Union, and why sort of, we're continuing to see dollar-denominated stablecoins dominate, and European stablecoins haven't necessarily made a dent in that, particularly from a consumer angle. One of the things that I talk about is that the local payment schemes in Europe are fairly mature. SEPA is one of the major payment schemes that we have. And really, when we think about stablecoin payments, that's not really replacing the incumbent solution that works today for consumers. However, in other jurisdictions where they don't have the history of a type of payment network like SEPA, then this is a fantastic solution. More recently, there's been an explosion on tokenized, on the use of stablecoins for tokenized assets, particularly within settlement. You can't settle, or you don't want to go off chain when you're trying to bring everything on chain to settle in fiat. Therefore, stablecoins are a brilliant mechanism to be able to settle tokenized assets, 24/7, 365 days a year, not reliant on traditional banking hours. And we're really seeing an explosion of growth in institutional adoption, alongside tokenized deposits and tokenized assets in general, including stocks. In terms of what's next, we're starting to see corporates using stablecoins, even between entities within the same group structure. We're starting to get requests from corporates to create their own stablecoins. We are in a place where we have followed the traditional innovation cycle. If we look back 6 years ago, there were just a handful of stablecoin issuers, and now there are many, many more, and it's growing. You'll continue to see stablecoins announced nearly every week, it seems. At the moment, there will be a consolidation at some point. We fully expect that to happen. But what we're seeing right now is absolutely that corporates are starting to bring these into their treasuries and starting to work out how they can maximize value. And in fact, I was speaking to a corporate the other day that has gone from looking at how they can maximize their treasury from a daily to an hourly to a minute basis, really using underlying blockchain as a technology, but stable coins to help them on that and their liquidity management. With that, I will say thank you for listening and hand back to Eric for any questions.
Thank you very much. This is very insightful, and we do have a number of questions. Let me address it. It's only 10:20 Eastern time, and we already have a jokester came in and asked if I was wearing real glasses. So I've changed my glasses just so everybody knows, if you can see, so that they look more real. But we have a number of questions, Myles, and this is really important. So I'm going to go to a couple that I know are really important to the whole audience, but we do have a few minutes. What is the most underappreciated risk for those who are looking to integrate stablecoins to their offerings?
So from my perspective, the most underappreciated risk would be really around counterparties and operational risk that arises from working and balancing, in some cases, on and off chain activity. And that's really what you're doing, particularly if you integrate or launch or support stablecoins as a bank or a regulated financial institution. Within that there are a number of risks that need to be managed, and that's really, I think, often underappreciated. I think we tend to look at, if I'm at a bank and I'm looking to add, or an FI and I'm looking to add a stablecoin, it typically conjures up a tech project in mind. And I think touching on the previous, caught the end of the previous presentation, very thematic there in terms of not just thinking about as a tech, but also thinking about the wider risks, managing the compliance aspects, the operational aspects. And I think that's sometimes underestimated.
You may just pick up on that a little bit more on this question. What mistakes did European banks make that U.S. banks should avoid, since you're a little bit ahead of us on this?
Yeah, so to continue that theme, I think that even now there are some banks that tend to think about this as adding a piece of technology or enabling a new currency, right? As if you would add an additional fiat currency to your offering, or it's treated like a bolt-on. Right, so it's like we're going to start supporting a stablecoin, and it's just a bolt-on. I mean, stablecoins are changing how consumers interact within financial services, and not just kind of consumers, like thinking about individual clients, but also corporates, and even within financial services itself. Card acquirers and merchants and how we move money and move cash between banks and deposits. So it's really thinking about holistically identifying all of those risks at the beginning and working out, how not just you will kind of go from idea to launch to add a stablecoin, but thinking how is it going to change the behavior? What do we need to look out for that might be different? What new risks might we expose ourselves to? And also where possible, and something I think is again underappreciated, is the benefits that blockchain can bring. So the traceability of funds and being able to use that in anti-money laundering practices and analysis, much greater transparency and visibility than sometimes tracking cash. And that's something that we don't, we're sort of so focused on sometimes trying to just think about how we make the product available and not necessarily using all of the benefits of the underlying technology that comes with it.
Great. Next question. Who dominates stablecoin issuance in Europe and other countries you operate in? Is it banks or private companies?
So right now, would say predominantly it's private companies, although what we are seeing, and in the last 12 months, we are seeing now banks and consortiums of banks, so banks grouping together to bring a stable coin to market. But what we're still seeing is, heavily dominated by private companies and issuers,
Okay, I'm going to stumble on this word, but I'll try it. Address the rehypothecation of stablecoin. Can you lend against reserves? Can you lend against stablecoin?
Okay, so this is an interesting topic. This is something that when I touched on the financial stability and the transparency particularly around the reserve allocation, this is something that MiCA is very stringent on, and we might see that over time that shifts, but it generally just similar to if you were holding a portion of cash, a certain amount of that needs to be highly liquid, and therefore it makes rehypothecation essentially not possible. And the regulators also in Europe would tend to expect a mix of instruments, particularly low risk instruments. So when we tend to think about rehypothecation, we tend to increase our risk level, and that's not something that is that the European regulators have appetite for from a reserve perspective for stablecoins. And we might see a shift as the market evolves and moves, and with maturity of the legislation. But that's not something that is ordinarily something that can be readily done today.
Great. The questions keep coming. So we have time for two more. Why should we partner with a Swiss bank why should we partner with a Swiss bank or a European bank instead of a US-based provider? Is there any benefit to that at this time?
Sure. So, I mean, we have, we've, as I touched on in terms of our timeline, we've been operating and working in a regulated banking environment and dealing with stable coins as well as wider and broader digital assets for several years now. So we are a little bit battle hardened. Like we have, lots of experiences, learnings that we've taken forward. We have experts that come from and blend together traditional finance and digital assets. And within Switzerland particularly, we have a strong regime around client protection and asset protection. So, for example, our stable coins and other crypto assets are held off balance sheet, and they are bankruptcy remote and protected. And that's all within our safe, secure banking environment that we've been building for the last few years.
Okay, last question. We don't have much time, and it's a long question, so the answer has to be the same way. At this time, is it feasible for an individual bank or a consortium of banks to issue their own stable coin, or will the big players such as USDC or Tether dominate? It's another prediction question, I guess.
Yeah, I mean, this is a really interesting one and fascinating. I think what we're also starting to see is incumbent stablecoin issuers applying for bank charters. Right, this is sort of the flavor of the month, as it were, at the moment. It seems there's a new announcement every week. So I think the stablecoin issuers recognize that there is that threat incoming from traditional institutions or digital banks that may be looking at their own. I think for now, I think we'll see both continue to coexist. Like I mentioned, we will see some consolidation over the next few years. But I think in the short term, and particularly as Clarity and Genius, both of those acts, are sort of eventually put into force and start to roll out, I think we will see both continue to exist for now. Yeah.
Myles, I really appreciate you coming. Thank you so much. This has been really informative. A lot of people asked if they're going to be able to get the slides. Yes, this will be taped. If you're already here, it's going to be it should be available next week. And Myles, if other people have questions, I'm sure we can get those to you, correct? And
absolutely,
let you follow up.
Yep.